Well, hi, everyone, and thank you for joining us here on the Trusting Disruption Stage, brought to you by Deltec. We're here for leveraging on-chain data to build trust and deliver alpha. My name is Andrew Hinkes. I'm going to be the moderator today. I'm a partner at K&L Gates, based out of Miami, and I'm a professor at NYU's Business School and Law School, where I teach a class called Digital Currencies, Blockchains, and the Future of Financial Services. I'm delighted to have an amazing panel today of experts and innovators in the field of using digital asset-generated data. I'd love for everyone to take a moment to introduce themselves.
Okay, let me start. So, Aurelie Barthere. So, I'm principal research analyst at Nansen, which is an on-chain analytics platform. It's named after a Norwegian scientist and an explorer. And what we do is explore on-chain data, label it, so kind of attribute labels, and then hopefully provides alpha to investors, filter out the noise for investment.
Hi, everyone. My name is Esteban. I am the co-founder and CEO of TRM Labs. We are a blockchain intelligence firm. So what we do is analyze transactions on blockchains to detect money laundering and fraud, everything from a ransomware attack to a rug pull to an investment scheme. And we package this data, we deliver it to regulators, law enforcement, central banks, financial institutions, and cryptocurrency businesses around the world to help them build trust on their platforms and their jurisdictions.
I'm Gurraj Sangha. I'm the Chief Quantitative Investment Officer of Tokenmetrics Ventures and also for Tokenmetrics. For the Tokenmetrics side, we're a crypto research platform, the leading one in the space. It's basically the crypto version of Bloomberg and legacy markets. And for our hedge fund, Tokenmetrics Ventures, I manage the quantitative investing strategies along with my partners, Ian, Belina, Hugo, and Diego, who are also here. And we've got a pretty interesting hybrid structure, 70% quant trading, 30% VC. And happy to share more as we move forward about on-chain data and how we use that in our process.
John Melican, I'm the Chief of External Affairs for Elliptic, and we're a blockchain analytics firm. We provide data on publicly available blockchains to enterprise clients, law enforcement, any consumer of blockchain data that wants to look at the data and analyze it. We provide information around the trust that's available there. So again, is it a wallet that has a history of sanctions interaction? Is it a wallet that has a history of risky interaction with the dark web? We provide analytics for traders on the type of information they'd like to look at, the flows moving between clients and wallets in the crypto space. And we're just happy to be here and talk with you.
Wonderful. So to frame out the discussion of how on-chain data can be used both to drive trust and to provide alpha, it's probably helpful for some introductory framing comments. When crypto assets first came to the fore, regulators generally considered them as wastelands and dark pools and places where there was no insight as to what was occurring on these platforms. And in fact, that couldn't be further from the truth. Blockchains are unique in that they publish information in a way that is open, transparent, and persistent. The result of this is that unlike TradFi, where there are companies that privately manage data about transactions, there's a rich forensic data set available. Now, that data set does not provide human identity necessarily to correlate with the transactions that occur. However, that doesn't stop us from using this information in ways to provide trust, to build in compliance for law enforcement purposes, and also to study this information to look for trends and create models in ways that can help to drive alpha. So this panel of experts, leaders, and innovators in the on-chain data analysis industry are here today to explain exactly how on-chain data is used to create trust and how it's used to drive alpha. So let's start with something pretty simple. What is different about the data that's created by the operation of blockchain systems from the data that we see in traditional financial transactions? Aurelie?
I mean, lots of differences. If you summarize it, there maybe 3 points. So like the first one is the granularity. The second one is the real-time characteristic of the data. And the third one is around the transparency. So I come from TradFi, so from a hedge fund world, and actually I made the move, and for me what was really super exciting and was really like the amount of data, the granularity, so you can literally query the history from the first node on and see what the wallet has done, how it has interacted with a token, or even not a token, if it's a smart contract, what was the transaction. So that's really pretty cool. You can do a lot around that. The real-time characteristics. So like if you're in TradFi, I don't know if anybody in this room has that experience. You need to wait for 1 week to understand if a trader has bought how many futures around the Aussie dollar or the overall market. So none of that here. You can just kind of query it, and then it's just the time of a block, and you have the data. And then on the transparency, so you can really see what wallets have done in the past. So what we do at Nansen is that we tag the quote-unquote smart wallets. So those are the guys that have made money in the past, maybe kind of minting NFTs or trading on dexes. And then you can see, for example, one cool strategy, you can see like how much stablecoins, how many stablecoins they have in their wallets. And that gives you kind of an early signal for risk sentiment. So for example, if you're a portfolio manager and you're wondering, okay, when should I take profit? What are the peak and trough of the market? This is a good input. Like if kind of those investors are very, very bullish and are starting to get bearish, kind of to rise their allocation to stable coins. We found that it's a good indicator for kind of the market turning more bearish. So yeah, that's 3 points.
Great. And Gurraj, did you want to make some comments about trust in this context?
Sure, absolutely. I think one of the interesting things about the volume and granularity of on-chain data is that, as Aurelie mentioned, not only the transparency, but the behavior that one can extract from this type of information. And in traditional legacy markets, it's very difficult. If we take, for example, yesterday's action by the Bank of Japan, in essentially indicating unlimited QE to support their bond market and the impact on the dollar-yen exchange rate, was a fairly large move. We cannot, in real time, understand which players are involved and what size of positions they are actually moving in and out of. But we can, through on-chain data, we can measure wallets, as already mentioned, the flows into and out of, what other assets they're correlating with. But the additional piece of interesting information is because we have that level of insight, that level of granularity, from a due diligence and risk perspective, we can understand are these entities, for example, on the sanction list or something of that nature, and are those wallets tarnished in any way or in one way, form, or another. So it provides not only interesting information, both from the granularity perspective, correlating with other pieces of data, which we use in our fund, Tokenmetrics Ventures, to generate trading strategies, but also provides us a great understanding of a much more holistic risk profile that we typically couldn't get in TradFi.
So Esteban, maybe you can comment on some native properties of blockchains that allow us to create this sort of trust.
Yeah, happy to. There's this conception that like cryptocurrency transactions are more risky or inherently more dangerous than fiat transactions. And we at TRM think that it's actually, in many ways, the opposite, that the inherent properties of blockchain, what we call the T2, P3 properties, transparency, traceability, public, permanent, programmable, those properties can make crypto transactions much safer and more trusted than in the traditional financial system. So let's look at a couple. You think about the transparency. In traditional finance, the data on illicit fund flows are in siloed data centers, oftentimes offshore, where you really don't know what's going on. Here, you can actually have a visibility of the financial system per se, and measure for the first time how much volume is directly linked to illicit activity. We've assessed that it's approximately 0.17% of the total volume that's tied to illicit activity in crypto, and that's why the headlines are here. The headlines are not because there's money laundering in crypto. There's money laundering in the US dollar, of course, The headline is because for the first time we can actually measure it. That's why there's a headline. When you think about traceability, if I'm a compliance officer, one of the things that I'll do as part of my anti-money laundering program is understand the source of wealth, the source of funds of my customers. And that's a very time-consuming process. It can take a long time to request bank records, to look at public registries, to really understand the source of wealth for my customers and ensure that my platform isn't being used to launder money. With tools like TRM, your exchange, your custody business, your asset issuer or NFT marketplace can actually automatically understand the source of funds of transactions coming onto your platform, and with much higher granularity, much higher accuracy, ensure that your platform isn't being used to launder proceeds of financial crime. Permanent. We have members in our team who led some of the, in a prior life in the public sector, they led some of the most notable cases in crypto, Silk Road, Alphabay, the Bitfinex hack. That was 2016, 120,000 Bitcoin that was stolen from Bitfinex. 2022, the 2 people were arrested for allegedly laundering those funds. Interestingly, the transactions, and this is all in the public statement of facts that was released by the DOJ, the transactions that may have helped to identify those alleged launderers were from 2017. Not 2022, not 2016. So when you're laundering funds or you're committing, an attack, you're hacking a smart contract, you're not just betting that the tools today will not be able to detect it. You're betting that the tools in the future will not be able to detect it. And if you're, a normal money launderer, you can always make mistakes and learn as you go. In crypto, the mistakes that you made 5 years ago are going to catch up to you. So we have this technology, and the last one I'll talk to you is the programmability, which you could actually bake in controls into smart contracts that enable people or addresses that have DeFi passports or have past KYC checks to seamlessly interact with financial services. So we're a big believer that over the next decade we're going to see the native properties of blockchain continue to be leveraged for good, to build more trust, build more safety, and expand access to financial services in a much more cost-effective and effective way.
Now, Esteban brought up AML, which is obviously a huge component of a regulated entity's compliance strategy. And AML presents some complex problems for crypto, but it also welcomes a host of new opportunities. John, do you want to talk about how on-chain data could potentially impact or augment an AML program?
Yeah, thank you. It's tremendous. The possibilities of being an AML officer in a space that involves assets like cryptocurrency are incredible. I've started out my life as an AML officer, first as a prosecutor doing money laundering cases at the Manhattan DA's office, and then into places like Bear Stearns, American Express, Bank of Tokyo. I've been doing money laundering cases for the last 20 years. This is possibly the worst place to launder money than you can describe. We have brilliant mathematicians, brilliant analysts, brilliant sets of computers all working diligently to analyze the data that everybody here has just described. The transparency, the openness, the ability to get that information in real time, analyze it in real time, makes it a terrible place to launder money. So for anti-money laundering, it's really a nightmare. What we've just described as the attributes of cryptocurrency make it a horrible place to launder money. At Elliptic, what we've done since 2013 was an amazing set of data, is really look and analyze this atmosphere, this new asset class, and watch every single interaction of every piece of data that flows between these wallets. And then we provide it for law enforcement, but mostly enterprise clients who need to look at scale at their wallets. They need to see what's coming and going at scale. So we're trying to add as many data sets as possible. We're analyzing new tokens, new blockchains, adding them as rapidly as possible because we know our enterprise clients are going to want to offer more tokens, more blockchains to more clients. They're going to demand that. At the same time, we understand that regulation now is not always going to be the regulation in the future. I think we were all excited about what happened with New York State DFS today, which is one of the most active AML regulators on earth. because New York State and New York City in particular sits at the financial center of traditional finance, all US dollars passing through literally lower Manhattan, they have incredible reach and power. And today they released guidance on the use of analytic tools for cryptocurrency. So their expectation is that when you are a financial institution which covers cryptocurrency exchanges, that you're going to use tools like Elliptic to analyze your data, to look for suspicious activity, to look for potentially sanctioned wallets. And you're going to look for that risk that may be intersecting with you and your clients that they expect you to protect. So it's an exciting time to be in analytics, and it's an exciting time to interact with the regulators.
So speaking of regulators and kind of harkening back to Esteban's comments a little bit ago about the use of this data for law enforcement, it seems as though we know this data is out there and it's useful and that use is developing. Gurraj, do you want to comment about the use of on-chain data for law enforcement purposes, what we're seeing and what we're going to see?
Sure. There is a recent hack of the Ronin blockchain, which I think most are familiar with, where Axie Infinity resides on. And the interesting part of that is not that the hack occurred. I mean, there are hacks, particularly when bridges are involved from time to time, which is one of the vulnerabilities in the system in general. But what was interesting is the speed with which the alleged actors were identified. And the FBI released a statement indicating that it appears that there were North Korean actors, the Lazarus group, as they called it, which were involved. And effectively what they had done is moved funds from the exchange, swapped it into Ethereum, and placed it in certain wallets. They tried to move assets from those wallets through mixers such as Tornado Cash, and then eventually into different exchanges to use as an on-ramp into fiat. They were able to identify, through on-chain analysis, the source of these assets who were involved and essentially sanction those wallets. Now, there's other parts of the process involved because these type of actors create other wallets, but once you've latched onto these certain set of wallets that are involved, the additional wallets can also be placed on sanctioned list. And this type of forensic analysis is much more difficult in traditional finance because of the nature of the movements involved, is either with the SWIFT system or other systems, and particularly when there's pure cash involved. Money laundering is a big problem. It's not so much easy to identify in TradFi, but the native characteristics of the blockchain allow for this type of analysis and the real-time analysis, which is typically not possible in TradFi. So I absolutely in agreement with the other panel members that it is a wonderful and positive development for the future.
So while we are seeing on-chain risks and we're seeing law enforcement acting swiftly in response to the data that's created, it's not just going to impact law enforcement and the policing of criminal actions using these assets. These sorts of activities have an impact on the value of these assets and strategies for investors. Aurelie, do you want to talk a little bit about how the ability to identify certain types of improper market activity can be used to drive alpha?
Yeah, so in Nansen we had the choice, and we chose, we kind of, when you have all this data, you can choose like the law enforcement path, which is really interesting and very specialized. We cater mostly to investors, but we don't have that high profile of criminals, but we also have kind of rogue traders to deal with. So like in traditional finance, for example, you can simulate a trade and then increase the volume, and then it looks like this new token like is attracting all these whales and all these smart investors. Yeah, the transparency of the blockchain also has kind of some drawbacks, but as a paradox, you can use that, use this transparency and kind of apply a layer of kind of heuristics on top of it. And for example, an example of in NFT, like there was kind of a big problem of wash trading. So it looks like the buyer and the seller are the common beneficiaries, but it looks like the kind of the volume is inflated. So what you can do, for example, with this transparency and with the heuristic, and kind of figure out, okay, look, this wallet is actually linked to this other wallet because we've clustered it and we've seen that they interact often with each other. So then you can remove and filter out the wash trading, and then you have a signal that is a little bit more informative for your trade. So yeah, so this is an example, for example, of addressing that for investment.
You make a fantastic point. What's really interesting is when you used to try to detect wash trading in the equities markets, you needed a subpoena. You needed to go to the SEC and get blue sheets and start looking at the interaction. Here, because of the public nature of it, you don't need that. You can see it yourself, and you can either take advantage of it or you can react to it.
Yeah.
But it's a completely different world than when you had to do it in equities market.
Yeah, it's faster too. Yeah.
Yeah, it's brilliant.
So with the open transparency of data that's created on chain, as we just discussed, there are new opportunities to identify certain types of abuses or criminal activities or market manipulation and so forth. But with these new technologies come new opportunities to find new and novel ways to take advantage of the markets or to act anti-competitively. And so this brings out new typologies and new areas of concern. Esteban, do you want to talk about sort of emergent areas of abuse and strategies around that?
Yeah, sure. I think broadly there's probably 3 buckets of illicit activity in crypto. There's you have cash, like fiat proceeds of financial crime that you're moving into crypto. You have crypto proceeds of financial crime. Maybe you sold stolen credit cards on the dark web, or maybe you conducted a ransomware attack, or maybe you conducted a hack. So you've got crypto proceeds that you now need to launder and get out into another currency. And then the final one is like maybe crypto native attacks. So it's not financial crime that's happening off the blockchain and being laundered with crypto. It's financial crime that's taking place on the blockchain. And we're seeing all sorts of interesting trends. When you think about like evolution in crypto money laundering, the fastest growing typology that we see is chain hopping. So folks moving funds across assets to evade detection, frankly, and thankfully we have tools, cross-chain analytics that can detect even that, and so we still can do our job. There's other typologies like programmatic money laundering, which is using software to programmatically move funds across tens of thousands of transactions. Similarly, we have software to be able to detect that. When you think about like crypto native attacks, there's we're seeing it now. We're seeing it play out very quickly. Whether that's rug pulls, a term that we used in traditional context, and now we're seeing that in crypto. I think one interesting one that we saw recently was essentially malicious smart contracts. Malware on the blockchain. You interact with the smart contract to try to mint an NFT, and in doing so, it actually swipes all of the assets from your own address. And so I think what we're going to see over the next few years is just more and more types of attacks be developed, and in turn, it's this cat and mouse game of developing the technology that can both detect and then mitigate and investigate those attacks when they occur.
So are these new emergent typologies coming from regulators who say, we see this happening, and so we want you to be aware of it? Or is it something that service providers that are analyzing the data are able to detect on their own and sort of socialize among the community?
Yeah, I think it's a bit of both. Money laundering is not anything new. It's happening a lot outside of crypto. And you can take the typologies that we see in the traditional world and port those over to crypto. So for instance, a common typology that you'll see in traditional finances is structuring or smurfing, where you might, let's say smurfing, you open a bunch of different bank accounts and you pay these mules to open up bank accounts for you so that you can split your funds into smaller pieces and launder it. We see the same thing. You brought up Lazarus Group, the cyber group out of North Korea. This is something that they do quite a bit in terms of opening up lots of different accounts to launder proceeds of financial crime. So part of it is porting over what regulators, organizations like FATF at the international level, FinCEN in the U.S., Monetary Authority of Singapore, and these authorities across the world have already identified and are now happening in crypto. And then a lot of it is finding things that are novel and truly like crypto native risks.
I think the analytics, just to add to that, the analytics firms are really in a great position to work with their clients to identify these new typologies. Waiting for MAS or FCA to come up with these is going to be a little late. As everybody's, I think, agreeing, money laundering hasn't changed over the years. Chain hopping is the same thing as stealing from an American Express gift card and then using it to buy a Visa gift card. Everybody moved from payment source to payment source. The Lazarus Group originally is at least credited in some parts of the world with the hack of SWIFT and the Bangladesh bank account. They just did it over a weekend to take advantage of the fact that the New York Fed was closed, which doesn't happen on blockchain. So you're seeing more instantaneous action, and the companies that surround and support this new financial world are really coming up with these typologies as they're happening. So chain peeling technology, cross-chain analytics, all things that everybody's working on and providing to their clients as these new typologies are being invented by criminals. It is an immediate war. And ideas like stealing cryptocurrency from crypto-native companies, it's unsuccessful for the most part because it's like stealing a car in long-term parking. You can take the car and move it from a spot, but if you can't get it out of the lot, if you can't get off-chain, you really haven't done much except move it from one space to another. So really, the success of some of what you see in the media is pretty limited. The Bitfinex people got caught laundering 0.00000% of the value that they actually stole. So I think that's why we're seeing these typologies develop and be knocked down as quickly as they can by the analytics firms and the folks on this panel.
So as I'm listening to these comments, it seems very clear that the two issues of using on-chain data to drive value for investors or for those that are interested in this area and in combating fraud and all sorts of other crime are really, they're really sort of married in the sense that there are certain actors like DeFi investors that may be managing third-party funds or might be fiduciaries or might need to have control over institutional assets who need to understand who their counterparties are. And so they need to have information to understand if they're going to deploy assets in a pool. Who else is in this pool with me? Is there 20% value coming from a recent hack? Is it 10% value that can credibly be traced to a sanctioned jurisdiction? And so companies that I've observed are interested in these opportunities, and they need these tools in order to understand how their compliance programs do or do not allow them to enter into these areas. And so I think maybe it's worth talking about how companies are using both the criminal detection tools as well as the pattern recognition and data analysis in order to drive value while also complying. Esteban, do you want to talk about, I guess, what you can call financial crime management for businesses?
Sure. So I think it really comes down to, if you're a compliance team and you're trying to manage financial crime risk, it's many of the things that you're familiar with: KYC, know your customer, customer due diligence. Of course, you're going to monitor transactions. You have record-keeping requirements. But then there's this question of like, well, what else can we do to manage risk? And leveraging on-chain data is a piece of that. So using tools like TRM or Elliptic, you can understand the source of funds for any deposit on your exchange. You can understand the ultimate destination of funds for transactions. You can understand suspicious patterns. And we're seeing people employ these best practices where they can actually configure the risk engine and tailor it to their own risk-based program. So they can say, well, in my jurisdiction, gambling is low risk, or sanctions exposure is really severe risk, or proceeds from a hack is going to be high risk, and people can kind of tune the risk engine to their own, frankly, to their own program. So that's really powerful. I think one of the really cool things is in traditional finance, it's this game of telephone where institutions have to file suspicious transaction reports and send that up to financial intelligence units or supervisory agencies in their jurisdiction. But in crypto, you actually have this shared language. You can say, hey, here's this transaction hash, and the supervisor has direct visibility. So for purposes of accountability, it's much more streamlined. For purposes of audits, it's much more streamlined because of this shared data set. One of the cool things that we're seeing is also evolution in risk management in new emerging areas like Web3 and DeFi and NFTs. We serve some of the largest DeFi protocols. We serve NFT marketplaces, and with DeFi protocols, obviously, the protocol itself may be permissionless and anyone can access, but you have interfaces that facilitate transactions that are often centralized, and those interfaces may implement controls such as sanction screening of particular crypto addresses. With the NFT, of course, you can understand the ultimate provenance, the chain of custody of the NFT, and so we're doing a lot of risk scoring for NFTs right now for marketplaces so that they can ensure that the proceeds of financial crime are not being locked into NFTs or they're not being misused.
So Gurraj, is this analysis, this sort of management function, is this necessarily retrospective, or can it be used in a way that it's also prospective?
We've looked at both sides of the coin with the retrospect. You're not only doing historical analysis, but also taking different points of the on-chain data chains, extracting features, and essentially doing forward analysis. In particular, we recently developed an NFT grade, which we're going to launch on our platform, which leveraged a lot of this type of data. And when we did the original testing, what we found is that with the right combination of features that we can extract from on-chain, plus understanding wallets, inflows, outflows, we can actually get a fairly good assessment of forward price action, enough so that it's investable. So certainly there's great benefits from leveraging as much of this data. I think in particular, the fact that there's great granularity, not only in the data itself, but in the linkages of the data with other sets of features, both on-chain and off-chain. It provides a much more holistic picture, not only for leveraging that type of information for investment purposes, but also for risk purposes. Esteban mentioned the great value in risk assessments, and we do that as well. So it definitely covers the entire gamut from a historical perspective to a forward perspective. But it's an area that we continue to explore, because what we've noticed is as much as we believe we understand, there's more and more parts of the across blockchains, the way that we can combine different sets of data that we haven't actually done yet. But as we do further work, we find it quite valuable, quite interesting. So it's definitely early days in this space.
So it seems as though this is a very powerful tool and that it's being used pretty widely. John, you want to offer up some instances or case studies where you think we've seen this type of analysis be particularly effective for law enforcement purposes?
Yeah, I think there's in the press there's a tremendous number of examples where theft or abuse of cryptocurrencies have been knocked down by the use of analytics tools. All of us have contributed a great deal towards, analyzing transactions from the pipeline hacked or ransomware attack to Bitfinex. Everybody looks at these things. It's stealing in this atmosphere is so public that everybody gets to focus their collective resources on those wallets, those transaction hashes, and it's a little bit like committing a crime in the middle of a stadium. Everybody's watching, and then they're waiting for it and waiting for you to make a mistake so that they can identify it. What we've seen, and I think was a tremendous effort by the whole community, and law enforcement included, was the recent sanctions on Russia. It's a little bit State Department, a little bit law enforcement, but really the whole community coming together, quickly getting out and adding Russian wallets, adding transparency to where the Russian money was likely to go if it chose to choose cryptocurrency as an exit for the sanctions that have been predominantly levied on traditional finance institutions in Russia. So I think that's a great example of where we've really seen these tools come quickly into action and really help things. I know everybody in the panel has probably worked on it recently, but it is a great example of this new asset class reacting very quickly and working very collaboratively with law enforcement.
So we've spent a lot of time talking about crime, and we've spent a lot of time talking about using blockchain analytics for compliance purposes, but maybe we should use our final 3 minutes to think a little bit more about what sort of analysis we can do with this public data in order to drive alpha, to inform investing strategies, and to pull more value out of this. Aurelie?
Okay, alpha in 3 minutes. Yeah, we can do it. So it depends on your investment strategy. So you can define it, and then you can get the data to kind of back it. Let's not talk maybe about systematic, but you can obviously do systematic strategies because you have this real-time property. If you're just a discretionary fund, let's say a liquid fund, and you want to identify the next Uniswap, you can actually tag the protocols that you're interested in, or even if you don't know it's a protocol that you're interested in, you can just kind of see, okay, oh, this entity has more and more new users, or more and more kind of users that are recurring, or actually their transactions are increasing in time. So you have the fundamental data to back that. And then maybe for macro traders, so for example, BH Digital, like Breven Howard, is entering the fields, and they're macro themes investors. You can look, for example, at indices. So we've developed NFT indices based on kind of liquid transactions. And what the interesting part is that this year, actually, the whole NFT performance was linked to social and kind of identity, whereas kind of gaming, for example, and art really underperformed. So these kind of insights are really interesting if you're a macro investor and you don't want to kind of have this or that token, but you want to build a portfolio, like your thematic portfolio. So 3 minutes or... Yeah.
So we've got just about a minute left, and I wanted to give each of our panelists a moment to share a final thought or another comment that they thought might be very helpful. Let's start with John.
Final thoughts is really this asset class is going mainstream. I think everybody's been in the other panels. This is going mainstream. It's going to attract traditional finance money. Pension funds are going to come in, and this panel, this group is going to have to help everybody scale. So we're going to have to get scalable and scalable fast, and that's essentially what we've been working on at Elliptic for the last few years, is getting to scale.
Absolutely. It is, there's a wealth of information that's available on-chain. There's numerous analytical tools will need to be developed, feature analysis and correlate that across other classes with legacy and in crypto. And I think in general what we found, even at Token Metrics, is that we continue to extract additional value, sometimes value that we didn't necessarily recognize early on. But there's enormous work to do, and I think the foreseeable future will be pretty productive.
Yeah, at TRM, our mission is to build a safer financial system for billions of people. And I think fundamentally we believe, a lot of the work that people in this room are doing to create a new financial system that can expand financial services, we need to have trust and safety. If there's a latent fear of investing in a rug pull or you getting hacked and not being able to call anybody, that's going to really hamper and put a ceiling on further growth and adoption. And so we're excited to continue to work on this mission. If you're a data scientist, if you're a data engineer, if you're a software engineer, if you're passionate about this mission, we are growing very aggressively. So please reach out.
Yeah, same. We are growing, so please reach out if you're a data engineer. We are hiring at the moment. If you're an investor, please reach out also. So personally, very excited about the development around the macro parts, kind of sectors, indices, tracking different wallets. So the whole heuristics part of it and how it can make for better investment decisions.
John, Gurraj, Esteban, Aurelie, thank you so much.
Thank you.
Thank you.
Okay.